This simple tool can actually boost your win rate as well as your profits. And believe it or not, anyone with a little of experience can understand it. But before, let's understand why we need it and what the problem is. If we look at the chart here, you will notice that a lot of the time when you're about to enter a trade and you have a range like this, price is break-in structure, and now we have this new range. So this is a break-in structure, we have this high, and we have this low. You'll notice that sometime what happened is price come into the range and then going lower, pushing lower, right? And you'll notice that we break a structure again and price goes to the range again, respect those highs. So this is a high here that is respected, and same thing here. Now in other times, what's going to happen is something like this, where we break a structure, but we take that high again and you lose your trade here. We take that high and then we go lower. And sometimes it also happen here. So you see this high here, price will take that high and then go lower and you will lose your trade here. What is that? That is an inducement. That is convincing you to enter off a specific range. So for example, creating a new breaker structure with a new range, but then it's taking the high and going lower. How do we avoid this? That's what today's video is about. How to avoid this, because this will actually give you a much higher win rate. But before getting into the main tool that is literally anyone can apply, we're going to discuss some other things that can also help you to avoid those inducements and to only look for high probability breaker structures and high probability trades after. Now, if we look at this price action here, what happened is we have this breaker structure and now creating this low. And how do we trust this range now? Is it going to be respected or not? One of the ways, and I'm going to go over two tools that can be also used, and then lastly go over the third tool, and in my opinion that's the easiest one that you can actually apply, and it's really mechanical. Like there is nothing subjective there. Now this is a valid breaker structure, but we need to make sure that there was at least a liquidity sweep that happened before, and then we had that displacement, and in that displacement we need to have a fair value gap. If price does not reach this fair value gap, for example here, and you were about to enter, so let's say for any reason, if it's reaching 50% here, you wanted to enter. If it's not coming off a fair value gap, then most likely know that price will disrespect that low again. What you see here is that we go to the high and we might have a breaker structure here on a lower time frame. But what happened after is taking that low. So you see how we create a new range here, but we took that low of the new range. And why? Because we have a fair value gap below it. We need to make sure that price is reacting off a fair value gap, and mostly 50% of a fair value gap. If we look at this fair value gap here, from here to here, you see how it's coming off a fair value gap and going higher. In this case, we can trust this range more, and you see how we had a fair value gap here also created after breaker structure. This fair value gap can also be trusted, and why? Because we're coming off another fair value gap and we fill at least 50% of the fair value gap. We have now this fair value gap, we can trust it. Now that's one other thing. Another thing is a liquidity sweep, same as here. You see how we had a liquidity sweep? We can actually trust this range because we had a liquidity sweep, and this one is inside of a fair value gap. So that's also a high probability one. You see, a lot of the times when price comes, especially here, you see how we fill 50%, break a structure. This new range that is created from here to here can be trusted, and that's why price went up after. This is how we only deal with high probability ranges, and that's how we can make sure that we are not being induced, because inducement is something like this, where we had this new range and we took the low of it. But if we're able to identify where our fair value gap is, react to the fair value gap, that's the first sign, another breaker structure, we have a new range that we can actually trust. So two things. First one is 50% test of the fair value gap. Another thing is the sweeping of liquidity, especially if it's another inducement. So for example, a high or low inside of fair value gap, or a high or low that is close to a fair value gap. That's an example of it. This low here has a fair value gap below it. What happened is a sweep into that fair value gap. That's also a type of inducement. What you see here is also the same. We had that liquidity sweep and we had that breaker structure here. So price goes lower, we have a new range. But how do we make sure that we are in the right range? One of the ways is looking at fair value gap and looking at the respect of the 50%. You see, that's the 50%. That's where price comes and goes lower, creating another range, even though it did not break the main structure, but that's a new range. And same thing here, 50% of the fair value gap. I mean, if we zoom in here, what you will see is that we had this fair value gap and 50% of it is right here. That's where price comes. Now we can enter after going to 50%, hitting the 50%. And that's a range that we can trust here. Another breakout structure. If we see price going into that 50%, we can trust it. I mean, even you can see here, we have this breakout structure, fair value gap here, reacted of it. You see exactly at the 50%, literally at the 50%. And then we break structure again. We can trust the new structure. And if you consider this structure here, price came to another fair value gap and pushed lower. Or if you wanted to look at the structure here, we had this fair value gap and price respected and then going lower again. Now, what is the other tool that is even easier than this? Literally easier to apply, and it can tell you if that low or that high is going to be a strong high or a strong low. And we're going to go over some examples. So the tool is having a fib with the golden zone of 0.618. We're going to be applying this in order to see if we have something like this. If we have price going up, coming lower, and then going up. Let's say that's the first swing here. In order to confirm that this is not an inducement after, and what does an inducement mean? It means that we had this breakout structure. Price is not going to take that low again and go higher. What's going to happen instead is going inside of this range and then reacting. So how do we confirm this? We're going to take our fib from the low of the range to the high of the range. If we can see that we had a retracement of a 61 and then we break structure, that means we have a new range that is high probability to hold. We have a new range that has what? A strong low here that most of the time will hold and will not be taken. Okay, that's the thing. However, if we have something like this where price goes somewhere in here and not to the 61%, what's going to happen after is mostly price again coming and creating this as an inducement, taking the inducement and going to the 61.8 and reacting of it. Let's see how we can actually use this in the market. You see those examples that we went over using the fair value gap. Now you can combine all those three methods together and you're going to get high probability trades. Now when looking at this range, we had this fair value gap, right? But let's say you don't know nothing about fair value gap and you are a beginner and you did not even see that fair value gap. What we had here is this range going lower and then going up. Now in this range, if I take my fib either from this low or this low, I'll take it from this low to the high here. That's our 61% right here. What you can see is that this low did not reach the 61 and started going higher. We broke structure here, or we sweep liquidity, whatever you call it. What happened after is what? Taking that low. And what is the reason? We did not go to 61%. If we go to 61%, that means most of the time that low should hold, especially if we have a clear breakout structure to the upside. But in this case, no 61. Even if you take it from this low, you see it did not reach the 61 and it looks like an inducement that is very close to 61. What happened after is a sweeping of that low, pushing higher. Now, if we apply the 61 again on another range, you see here in this range, it barely touches the 61. Actually, it touches almost the 61, yeah, but it did not react the first time of the 50%. So that's another thing that you can apply together, right? Now, looking at this also price action here, we had a clear breakout structure. We created this high. Now, regardless of the 50% of the fair value gap, creating that inducement. But what we can also see is that from the high to the low, see how price did not reach the 61. We know that this high now, regardless of the breakout structure, is an inducement. And now price comes to 61. That's the strong high now, especially after creating another range and breakout structure. Now, same thing here. What we can do is grab our fib from the high to the low here, and you can see that price did not reach the 61. That's proving that this is now an inducement. And you see how we started going lower, and what happened after is price reacting of the 61 and then pushing lower, and also filling the whole fair value gap. So those are two confirmation as well as sweeping this liquidity. So those are three confirmations that we talked about today. Now you see here what we had also on any price action leg, but you want to focus on high probability ones. You see this range here. What we had is, we started going up until this point, and then we retrace lower exactly to 61% when this fair value gap was already filled, 61%, and we started pushing higher. If we don't take, so you see in this example, we took a major liquidity level. In this case, it becomes less probability. But if we had price before taking that liquidity and it was retracing somewhere in here, this would be a high probability one to go higher to take that liquidity level. And after that, it becomes less probability because now we have a new range and a new liquidity to look at. Now, this can also be applicable on any time frame and any pair. What we can see here is that at this point, we had a market structure shift going lower. In this case, if I'm looking at this range and I want to trade off it, when doesn't make sense to enter off it and when it's a high probability, we take our fib from the highest point to the lowest point. In this case, price did not reach the 61. So still, we're not done with this range. At this point, to the the lowest point here, we did not reach the 61. And we get very close to it, but going lower again, a lot of people might look at this as breakout structure and we're looking for lower prices. What happened after is taking this as an inducement, reacting off the 61, taking also another liquidity level, and then going lower. That's the importance of the 61. Now, the same thing here. You can see this new range. We did not retrace to 61. And another time, we did not. Still, we did not get to 61 where there was a liquidity level here. So this still becomes lower probability, but sometimes price will just go into one direction. We have a new range created here, even though it's not the highest probability one. Very close to the 61, we had a fair value gap where price did not take, and it barely fills the fair value gap, not even to the 50%, which the 50% is around here. So almost the same as the 61. What happened after is price coming to the 61, filling the fair value gap, and then pushing lower. So this now tells you that, okay, we're done with this range and we might go lower. And another breakout structure. Sometime, especially in this range, I don't like trading because we had this main range here that is not filled to the 61 as well as this one. And then if we keep going lower until this one, because I'd consider this as a whole range. And you can see that we have 61 here. We might see price, disrespecting all of those new ranges and just going up to the 61 and then going lower because we have a lot of unfilled ranges. Remember, the filling of a range means price going to the 61 and then breaking structure. So that's a very simple tool. I hope you guys learned something new today. I hope you can apply this in order to have a higher win rate and make more money on the market. If you think this video will help someone, then make sure to share with other friends, hit the like button and leave a comment. That's it for the video. This is Mulham and I'll see you next video.